So we're going to kick it off with the first session, which is mortgage refinancing. The first paper is More Tax, Less Refi by Eileen van Straelen.
Hey, so thank you so much for having me on the program. Today I'm going to discuss More Tax, Less Refi, the mortgage interest deduction, and monetary policy pass-through. And this is joint with Straelen, who's also at the board, and so the usual disclaimer applies. Okay, so monetary policy can stimulate consumption via the refinancing channel. So interest rate cuts that lower the cost of mortgage borrowing allow households to refinance, thus lowering their mortgage payment and freeing up cash for consumption. So understanding frictions to this transmission channel are important for monetary policy, financial stability, and borrower welfare. And there's been previous work documenting other frictions to this channel coming from barriers to competition amongst mortgage lenders, employment documentation requirements for refinancing, and equity levels or equity requirements for refinancing. And in this paper, we're going to document a previously little studied friction to the refinancing channel, namely the mortgage interest deduction. So, why would the mortgage interest deduction affect monetary policy pass-through? So just for some background, households can deduct mortgage interest from their taxes when they itemize. So if a household's total deductions fall above the standard deduction or the itemizing threshold, then they deduct their mortgage interest. And for these households, for the portion of their mortgage interest that falls above the standard deduction, this means that their mortgage rate, they pay an after-tax mortgage rate of R, their pre-tax rate, times 1 minus the tax rate. So their mortgage rate is discounted by the tax rate. And this actually has important implications for refinancing, because when you refinance, the benefit to refinancing we typically capture is the difference between your current mortgage rate or your outstanding rate, R naught, minus the rate you would receive if you were to refinance at time T, so R sub T. So the bigger this rate gap, the bigger the benefits to refinancing. But if you're deducting mortgage interest, then the benefits to refinancing are reduced by 1 minus the tax rate. So by reducing the benefits from refinancing, the mortgage interest deduction may actually reduce the sensitivity of refinancing to mortgage rates. So in other words, when interest rates fall, you might end up with fewer borrowers refinancing than would otherwise be the case because many of them are deducting mortgage interest. So in this paper, we're going to study the effect of the mortgage interest deduction on refinancing. But studying this question empirically is challenging because there's an endogeneity concern in the sense that both observable and unobservable factors can drive both your tax status, so your total deduction amount, and how sensitive you are to refinancing. So in general, households that deduct mortgage interest are going to be wealthier and have higher income. And these households may also be more or less likely to refinance. They may have different levels of financial sophistication. So we get around this endogeneity concern by exploiting a sudden shock to the value of the mortgage interest deduction, namely the Tax Cuts and Jobs Act bill of 2017, or the TCJA. Now, this bill dramatically changed the number of people deducting mortgage interest. And for the households that continue to deduct mortgage interest, it dramatically reduced the value of the interest subsidy. And it did so by doubling the standard deduction. So before the TCJA, the standard deduction was about $12,000 for joint filers. And after the TCJA, the standard deduction doubled to about $24,000. So what we'll do is a dip and dip analysis where we'll compare borrowers who never benefited from the subsidy before or after the bill to borrowers who were deducting mortgage interest before the bill and then saw a decline in their subsidy following the bill. And any change in refinancing that we observe following the passage of the TCJA between these two groups, we can attribute to the loss of the interest subsidy. So we find that refinancing increases following the TCJA. So for the most affected borrowers, we see that a 19 basis point decline in the subsidy leads to about a 0.5 percentage point increase in refinancing, which is about a 25 percentage point increase from the baseline refinancing rate. So this is a pretty large elasticity. It's like more than 1-to-1 of refinancing to interest rates, but it's similar to estimates from the QE1 period. And we also show the magnitude of this effect is increasing in the size of the subsidy loss. So households with the biggest decline in the subsidy see the biggest increase in refinancing. We also show the effect is concentrated amongst borrowers who are typically the most sensitive to interest rates, who are most aware of their refinance incentive. And we show evidence of parallel trends, that the gap in refinancing between affected and unaffected borrowers only appears following the TCJA, but not before. So altogether, we conclude that the mortgage interest deduction meaningfully dampens the refinancing channel of monetary policy pass-through. And our results suggest that the repeal of the mortgage interest deduction may have contributed to recent mortgage rate lock, in the sense that the repeal of the mortgage interest deduction encouraged more households to refinance during the pandemic than otherwise would have, and thus lock in very low rates. And these households are now out of the money to refinance and thus to move in 2023 and 2024. So in this analysis, we faced two main data challenges. We had to predict a household's itemization status, so whether or not they deducted mortgage interest, and we had to predict their refinance incentive. So we predicted a household's itemization status using the three biggest components of the household's total deduction amount. So their mortgage interest, their property taxes, and their state income taxes. So we define a household's deduction is equal to these three components. We will be missing some smaller deductions, such as charitable contributions, but we'll show you via a validation exercise that our estimate of the household's itemization status roughly tracks what you see in the IRS data. Next, we need to calculate a household's refinance incentive. And here we're going to define the refinance incentive as the rate gap following the literature. So this is a difference between the borrower's outstanding rate and the rate they would receive if they were to refinance at time T. And so we're going to do that we're going to get that available refi rates using a sample of recent mortgage originations in optimal blue. So we'll regress new mortgage rates and borrower characteristics, and then we'll use that model to calculate the rate a borrower would receive if they were to refinance at time T based on their observable characteristics. And then we'll use a sample from the HMDA-CRISM data set. And we'll use the income variable from HMDA to calculate a household's state income tax burden and federal income tax burden. So we'll feed that variable into TaxSim to get the tax burden. And then we'll calculate property taxes using the escrow variable in McDash. So again, this will be noisy because McDash reports the escrow variable, not the actual property tax amount. So we're going to bundle in some homeowners insurance in this variable. But again, we're going to show that our estimate of the deduction amount roughly tracks what we see in the IRS. And then we'll get the household's mortgage interest payment from McDash. So we'll pull the outstanding rate and the mortgage balance to get the mortgage interest payment. And we'll use CRISM to distinguish the reason for a loan's prepayment. So what did the loan prepay because of a rate term refinance, a cash out refinance, or a move? Okay, so here's just some background on the structure of the mortgage interest subsidy. So on the x-axis, we're showing a household's deduction amount. So where we're defining deduction as the sum of the mortgage interest, property taxes, and state income taxes. And then on the y-axis, we're showing the household subsidy rate. And we define the subsidy rate as equal to 0 if your deduction falls below the standard deduction, and equal to T, so your tax rate, times P, the fraction of mortgage interest that falls above the standard deduction, for households whose deduction falls above the standard deduction. And we can write the after-tax mortgage rate as equal to your pre-tax rate times 1 minus the subsidy rate. And so looking at the graph, you can see we have two vertical red lines. The first corresponding to the original standard deduction threshold of $12,000. And the second is the post-TCJA new standard deduction threshold of $24,000. So looking at the figure, you can see that for households with lower deductions below $12,000, these households experienced no change in the interest subsidy before or after the bill. They had zero subsidy in both periods. But for households with deductions between $12,000 and $24,000, these households before the TCJA saw their subsidy rate increasing with deduction amount. And following the TCJA, that subsidy goes to zero. So for these households, they experience a decline in the value of the subsidy that's increasing with their deduction amount. And then for households with very high deductions, so households with deductions above the new standard deduction threshold, deductions above $24,000, these households see the biggest decline in the value of the subsidy, although they continue to itemize even after the bill passes. So they're continuing to benefit, they're continuing to get a small benefit from the mortgage interest deduction. And so we can use this figure to see if we see an increase in refinancing along the distribution of deduction bin, where we would expect given the different changes in the subsidy value or the subsidy rate. Here we just have some motivating empirical patterns. So this is not from any regressions, but we're just looking at refinancing rates before and after the TCJA by a household's deduction amount. And so looking at this figure, you can see there's an increase in refinancing at exactly those points in the deduction distribution that you would expect if households were responding to the loss of the interest subsidy. So households with low deductions see no change in the refinancing rates. Households with intermediate deduction levels increase their refinancing, and that increase is increasing with the deduction amount. And then households with the highest deductions see the biggest increase in their refinancing rates. So this is suggestive that households are responding to the loss of the interest subsidy. Now, one concern is that other important drivers of refinancing are changing in the same way along the deduction distribution following the TCJA, and that's driving the effect we see. One potential important driver of refinancing is the refi savings variable, which we're defining as the rate gap times your remaining principal balance. This is an important driver of refinancing, and so we just check here that following the TCJA, there's no increase in the refi savings variable that maps to what we see for the refinancing. And in fact, there's very little change following the TCJA, indicating that refinance savings is not driving the effect that we see. Now, the mortgage interest subsidy has a highly geographical component because it's dependent on local house prices, incomes, and in particular, your state income tax and your property taxes. And so here we're just showing the change in the household subsidy value following the TCJA, broken down by geography. And you can see that California and the Northeast have some of the biggest declines in the value of the subsidy. And this is consistent with these areas having higher state income taxes and property taxes, whereas areas like Nevada, which have no income tax, see very small declines in the subsidy. So certain areas of the country are much more affected than others. So this is the main empirical specification that we'll use in the paper. So we'll regress the probability that a household I refinances at time T on a triple interaction of a post dummy interacted with a household's refinance incentive, interacted with the household's change in their subsidy. And then we'll include a number of controls for borrower and loan characteristics, such as LTV, DTI, credit score. And we'll also include a number of fixed effects, psi. In particular, we control for each component of the deduction amount interacted with quarter fixed effects. And we do this because a household's deduction is comprised of their mortgage interest, their state income tax, and their property taxes. And so you might be concerned that, say, high balance mortgage borrowers become more likely to refinance following the TCJA for some other reason. And because higher balance borrowers have higher mortgage interest, they're going to have higher deduction amounts. And so that's driving the effect we see. So to address this possibility, we control for each component of the deduction amount interacted with quarter fixed effects, meaning that any variation that we're identified off of is coming from just the change in the tax policy itself. And we also include controls for zip code by time fixed effects to soak up any kind of changes in income over time. And we estimate this using the linear probability model to account for the large number of fixed effects, and we cluster standard errors by zip code. Now, what we'll do is we'll estimate the specification in 3 different ways. So we'll look at it cut by deduction bin, cut by borrower rate gap, and also in the time series. And we'll show that we see an effect of the TCJA appear at each point in the deduction distribution, the rate gap distribution, and the time series that we would expect if this effect were being driven by the loss of the interest subsidy. So here we look at the effect cut by deduction bin. So in this figure, we're plotting the change in refinancing following the TCJA for each bin of borrower deduction amount. And we split this by in the money and out of the money borrowers. So looking at the figure, you can see that households with low deduction amounts see no change in their refinancing following the TCJA, whereas households with deductions above $12,000 see an increase in refinancing, and that increase is increasing with their deduction bin. And households with the highest increase in refinancing rates are those with deductions above the new standard deduction threshold. And we see this only for in-the-money borrowers, not for out-of-the-money borrowers. So just interpreting this figure, for higher deduction borrowers, a 19 basis point decline in the subsidy is associated with about a 25 percentage point increase in the refinancing rate. So this is an elasticity of refinancing to rates of a little bit more than 1. Now we next cut this effect by borrower rate gap. So in this figure, we're plotting the coefficient on 25 basis point bins of borrower rate gap interacted with the subsidy loss in the post-dummy. So this figure is telling us that for households with rate gaps that are out of the money, so negative rate gaps, there's no effect of the loss of the mortgage interest subsidy. For households with rate gaps between 0.5 and 1, these are in the money borrowers, we see an effect of the TCJA, an effect of the subsidy loss that's increasing with the size of the rate gap, as you would expect. And then for very in the money households, for rate gaps above 1.5, we see very little effect. And this is consistent with the fact that households who are very in the money have been shown to be pretty inattentive to their rate gap. And so it's consistent with these households being inattentive to their rate gap. They also are probably inattentive to changes in the tax treatment of that rate gap. So we see that refinances increase the most strongly for rate gaps in this intermediate region of about 0.5 to 1, which are historically the most attentive to their refinance incentive. And next, we look at parallel trends in refinancing before and after the TCJA. So to do this, we estimate a regression of refinancing on a triple interaction of quarter dummies with an in-the-moneyness variable and a variable for itemizer type. And this variable takes on 3 values. So never itemizers, the omitted category, are households that never deducted mortgage interest in the pre or the post period. They're not affected by the bill. Switchers are households with deductions between $12,000 and $24,000. These households deducted mortgage interest in the pre-period, but not the post-period, and they saw an intermediate decline in the value of their subsidy. And then always itemizers are households with deductions above $24,000. These households continue to deduct mortgage interest following the bill, but they saw the biggest decline in their subsidy. And so when we look at this plot, you can see that households who lose the interest subsidy, who see the value decline, see their refinancing increase following the TCJA compared to households who never saw a change in their interest subsidy. And the increase is strongest for the always itemizers, households with the biggest decline in their subsidy. Now we see an increase in refinancing appear in early 2019, whereas the TCJA came into effect in January 1st of 2018. So it took more than a year for us to see an effect in the data. And we think this likely reflects the fact that households only filed their taxes for 2018 in early 2019. And so households may have only become aware of the fact that they're no longer eligible to deduct mortgage interest in early 2019, which is when we see an effect in the data. So, altogether, we're seeing an effect of the interest subsidy loss at exactly these points in the time series, the rate gap distribution and the deduction distribution that we would expect if the loss of the subsidy is driving refinancing. We also have some kind of suggestive aggregate evidence that households have become more sensitive to their rate gap. So looking at this figure, the blue line is showing the in the money share, so that share of households in the money to refinance. And the red line shows the average refinancing rate. So looking at this plot, you can see that, the share of households in the money in 2019 is about 25% lower than in 2016. But the refinancing rate in both periods is roughly the same. So this seems as if households have become, more likely to refinance when in the money in 2019 as compared to in 2016. Consistent with the loss of the mortgage interest deduction affecting households refinancing. Now we next look at whether or not the TCJA changed consumption patterns out of refinancing. And we do this because we know that from previous literature, there's a relationship between refinancing and consumption. You refinance and that tends to lead to more consumption. It's also possible that because the TCJA reduced the interest subsidy, that means that when you refinance, you're pocketing more of the interest savings than you've been in the past. So your interest savings are no longer discounted by the tax rate. And so it's possible that you become even more likely to consume out of those interest savings than you had been in the past. So to test this, we look at the probability you open an auto loan in the months immediately following a refinance. We do this in the chart on the left for before the TCJA and after the TCJA. And you can see that there's a rise in refinancing, or there's a rise in the probability of buying a car post-refinance following the TCJA. However, when we interact this effect by the subsidy change, we don't see much of an effect, indicating that households have not become more likely to spend out of their refi savings following the loss of the subsidy. This could happen for a number of reasons. When households refinance and when they file their taxes occur at different times, which might make it difficult to pick up this effect in kind of a short window around the refinance. And it's also possible that, somewhat small changes to your interest savings might not be enough to move the needle when it comes to a large burden-funded car. So we conclude that the consumption response to the TCJA is proportionate to the extensive margin response, meaning that the TCJA increased consumption by increasing the number of refinances, not by increasing the tendency to consume out of your refinance. So to conclude, we show that the loss of the mortgage interest deduction due to the TCJA increased the sensitivity of refinancing to mortgage rates. So we show that for the most affected borrowers, about a 20 basis point decline in the subsidy leads to about a 0.5 percentage point increase in refinancing, with about a 25% increase from the baseline. So an elasticity of refinancing to rates of slightly more than 1. And we show the effect is strongest for those households who see the largest reduction in their mortgage interest deduction. And we see an effect appear exactly at those points along the deduction bin distribution that we would expect if the subsidy loss were driving the effect. And we also show that the increase in refinancing is driven by borrowers on the margin of being in the money to refinance. So borrowers with rate gaps between 0.5 and 1 or 1.5, which are historically the most rate responsive group. And we see that the gap in refinancing appears only following the TCJA and not before. So altogether, we conclude that the mortgage interest deduction dampens the pass-through of monetary policy via the refinancing channel. And I'll turn it over to Daniel.
Our discussant is Dan Garrett from
Awesome. Thank you so much. And thank you for the great presentation, Eileen. This is my discussion of More Tax, Less Refi by Tess and Eileen. I want to note, for starters, I'm not a mortgage person. I'm not a household finance person. I'm a tax person. So I'm going to try to keep to my time so that you all can ask the good mortgage questions after my 10 minutes. But I want to bring up a little bit of context and a little bit of thought about the tax background here. So to remind you all, the income tax started in the US in 1913. Back when it started, the mortgage interest deduction was not intended as a homeownership subsidy or anything like that. All interest was deductible, and everyone would deduct everything. So there was no standard deduction. But then kind of over the next 104 years, we wound up in 2017 before the Tax Cuts and Jobs Act. And most individuals take a standard deduction. The standard deduction at the time for a married couple was in the realm of $12,000. But about 1/3 of individuals will itemize deductions. That is, there are certain things that are deductible, that have always been deductible, but instead of taking the standard amount, you're going to itemize them because it's larger than 12,000. So essentially, on your mortgage, instead of paying the mortgage rate itself, you pay the mortgage rate after tax on the share of the mortgage interest that is above this kind of threshold. And so I could note that we do think of this now as a subsidy for homeownership, and we think this lowers the cost of homeownership a little bit. I'll come back to that in a second. So what TCJA did is it did two things. It really substantially increased the size of the standard deduction from about 12,000 to about 24,000. What we see is about 18 million fewer households are going to deduct mortgage interest in general. So it goes from something like 32 or 33 million to something like 13 million households. So a huge number of households suddenly stop deducting. And so on the margin, this is a really big change in incentives. And on average, it's maybe a slightly different change in incentives. I'm going to come back to this average versus marginal in a little bit. But so we can kind of break people who respond to this into two groups. They're the no longer itemizers. These are switchers. These are people who used to itemize their mortgage interest and they no longer will. And there are people who are going to continue itemizing, but now the subsidy is a little bit less. And so here on the left, we can see the average size of the subsidy. On the right, we're going to see the imputed marginal return on pay down. You can think of this as the change in marginal incentives due to the subsidy. And so this is a really, really big change in how much mortgage interest is subsidized in the tax code. So what do we think about mortgage interest subsidies in the tax code in general? Well, I should note that the public finance literature and public finance economists tend to think of the mortgage interest deduction as a little bit wasteful. I'll kind of note three things here, one of which is the spillovers due to marginal homeownership are relatively small. So if we think there might be externalities that we're trying to inspire through kind of the mortgage interest deduction, people have argued they're quite small historically. Also, there's a lot of literature that home ownership changes on the extensive margin are usually quite small. This is true both in the US and outside of the US where these similar sorts of interest deductions exist. But there are larger intensive margin responses, which is people respond to the mortgage interest deduction by usually buying larger houses, having larger loans, or maybe smaller loans if there are certain discontinuities. So I think the current paper is a really cool addition to this literature, and that it's got this novel fact that MID also dampens the response of households to monetary policy by changing the way in which they refinance around, by changing the way in which they respond to refinancing incentives. So I think it's a really cool paper. I think it's a novel empirical question. I'm going to restate the question and kind of how I see the question, which is the mortgage interest deduction empirically relevant as a driver of refinancing rates? And I think the paper finds yes. It's great data for the question. We have the kind of standard merged Humda, McDash, and Crisum. And it's a pretty straightforward method, which is this diff and diff, or you can think of it as a triple diff interacting with whether you have an incentive to refinance in the first place. They find that the Tax Cuts and Jobs Act does weaken the mortgage interest deduction, of course, and this leads to more refinancing. It, however, doesn't lead to any deleveraging through paydowns. It doesn't lead to any new change in cash out refinancing. And there is this consumption response that kind of might happen on the extensive margin through buying more automobiles for those who ex post do refinance. I also note there is this kind of broader takeaway that I think is more important than just the mortgage literature, which relating back to the older literature on the mortgage interest deduction, the response of mortgage debt to interest subsidy operates entirely through new homeowners taking on more debt at origination and by buying larger homes. And I want to add, and by refinancing. I think this is the way in which I pitch the paper, adding also a lot to this broader literature. So the main finding in the raw data jumps right out of the graph. We can see if we sort households based on the size of their deduction, households between 0 and 12, they were never using the mortgage interest deduction. There's no change through TCJA. There's no change in their refinancing rates. Their refinancing rates are always low. Then as you get in this intermediate range, you can see in the blue lower dots, pre-TCJA, there was less refinancing. Post-TCJA in the red upper dots, there's more this kind of increasing in the size of the deduction in a way that makes sense. So this is in the raw data. Then, of course, in the regressions, they add all sorts of fixed effects for the size of the rate gap, the zip code you live in, how much state and local taxes you're paying, which is what SALT means, state and local taxes, and what the balance of the loan is. So I have a few comments. These are kind of high level, and some of them are unfair in a few ways. And so I'll try to say where they're unfair. And they still kind of come from my first naive reading of the paper after I went and dug through it. I think that they're a little bit less fair, but I'll get there. So the first is on the monetary policy pass-through interpretation. I want a little bit more clarity on what assumptions are required to get there. So 2 stylized facts. TCJA had huge impact on incentives for mortgage interest. And so if it hit about 30 million households have weaker incentives now for taking on a mortgage than they did before, and might have a kind of stronger incentives to refinance. And the magnitudes of the paper are large. So to me, this is a substantial structural change in the likelihood of refinancing that is described by this sort of response. And so a complication here, of course, is that equilibrium mortgage rates are a function of aggregate refinancing likelihood. And so if aggregate refinancing likelihood increases, we should think that this is going to kind of change equilibrium pricing of original mortgages. And this seems like a countervailing wind in general equilibrium to the increase in refinancing, which could totally undo all of the increase we see here. So I want to know a little bit more about what assumptions do we need to interpret the results we see as a change in total monetary policy pass-through. I think this is a little bit deeper than a standard missing intercept problem. And that, so of course, this is a reduced form paper. We're comparing people who have one treatment to people who don't. And so there could be reallocation across them in general, but I think here it's a little bit more about reallocation to the total economy. And I want to know a little bit more just kind of what assumptions do we need to say that this is monetary policy pass-through that was saying monetary policy was passing through less before. Now we've weakened the mortgage interest deduction. Now we're getting greater pass through, and this is going to lead to kind of more responsiveness that's not also priced in general equilibrium by mortgage originators. So second, this is going to be the taxi one. The main shock in the regression is subsidy change. And so subsidy change is defined as the tax rate multiplied by P sub post, which is the proportion of the mortgage interest payment that is above the itemizing threshold, minus the tax rate times the portion of the mortgage that is above the itemizing threshold in the first place. So P is the important parameter here, and I don't understand how the paper is pinning this down. And I think it's a really important thing to talk a little bit more about pinning down. So the calibration of P across the deduction distribution is really important to make statements like the mortgage interest deduction declines the most for always itemizers and the least for never itemizers. I don't quite follow exactly. I don't quite buy that statement exactly. I think it's broadly true, but not always true. So let me give you just a little bit of background on what this looks like, what deductions look like in 2021. So this is from the IRS SOI data, and this is a little bit unfair because I'm aggregating the entire income distribution. This looks a little bit different if you limit to households, say, under $200,000. But what we see is contributions are about 40%. Taxes paid, state and local taxes, is about 18%. Mortgage interest is about 21.7%. So what the paper is able to really carefully document are taxes paid and mortgage interest. But on average, other deductions are larger. And the average itemizer, conditional on itemizing, is not marginal to the mortgage interest deduction. The average mortgage interest deduction is smaller than the amount they are over the threshold. And this is true even if you limit to slightly lower levels of income. So to me, what this tells me is there's a subset of borrowers for whom P is always equal to 1. And if P is equal to 1, our shock is actually much smaller at the upper end of the deduction distribution. And so, of course, it's really hard to measure who those people are, but I would like to know a little bit more about who they are or who they could be and how that might impact the paper. So I'm thinking, is this a source of measurement error, or is there a source of P being correlated with the deduction in a way that is important? And is there any way you can maybe use SOI data to get at that? I have a numerical example I'm going to skip about me and my evil brother who doesn't donate to charity to kind of highlight that, but I think it could be important. I should also note the paper does a careful job to, with descriptives to focus on the low salt portion of the distribution, but of course, there are lots and lots of people who are giving to charity, and I think that's an important part of something to think about insofar as it moves the intercept for P and where P exists. Third, I want to naively restate the question and give you some thoughts about identification. So TCJA is definitely a shock to the mortgage interest deduction, but it's not the most obvious way of asking, is the mortgage interest deduction an important impact of monetary policy pass-through? So my way of thinking of this is what we're getting out of TCJA is the fact that there are cross-sectionally people who have lots of mortgage interest deductions, those who have less, and there's selection into that. But that selection, of course, is interacting with time in a way that no one knows when TCJA is happening. And so that's kind of what gives you exogenate. But I think that's true of any monetary policy shock. And so maybe someone can tell me why I'm not any, many monetary policy shocks where there's a distribution of people, they have MID and they don't exist, or and they don't have control over monetary policy themselves. So when I look at this, I had a naive reading. And so my naive reading is wrong, but I'm going to give you my naive reading in case it's helpful, which is always itemizers still have MID at least a little bit. Switchers no longer have MID afterwards. And so what we see is in the second quarter of 2019, of course, monetary policy shocks and interest rates go down. The people who always itemize actually increase their refinancing a lot more, even though they're the ones who still have MID. Now that's an unfair reading of this because a lot of what's actually going on in the switchers is there's most of the variation is in the switchers. But that's an unfair way of reading this that I think a naive reader is going to see. I think the easiest way is just add more data in the background, add some placebos. So I'll leave it at that. It's a really fun paper. I think it's really well written. You should read the paper. And it has a lot of important stuff. And so I can't wait to see where the paper goes next. Thank you so much.
Hi, I'm Maggie Jacobson. I work at the Federal Reserve Board. And one thing I think is really nice about the monetary policy application here, they're looking at the in the money. So it's at the individual level and they don't really have to get into the really complicated are people reacting to the systemic component or the shock component here, which is a whole nother kind of very complicated assessment. So I think in terms of actually pinning down how people react to monetary policy on a sort of individual level, I think this is a really nice contribution.
If I'm remembering correctly, there was also at the same time like a change in the maximum amount of mortgage interest that you could deduct. It was reduced from $1 million to $750,000, and then wasn't there kind of like a grandfathering? Like if you had an old mortgage, you could keep it at $1 million. I was just wondering how that. Maybe you talked about this and I just missed it, but I was just wondering how that if that factors in and how. So that gives you more of an incentive to kind of keep your old. Like even if you just refinance the same loan, you would lose that kind of additional $250,000 of deductibility. I was just wondering how that factors in. Do you know what I'm talking about?
Yeah, exactly.
Yeah.
So that's a good point. Like the TCJA changed like a number of features about the household tax code. One of which it doubled the standard deduction, but it also, as James is saying, it reduced the cap. There used to be a cap on the number or the size of your mortgage at which you could deduct interest. It went from $1 million to $750,000. And it was grandfathered. So if you already had a mortgage, then you wouldn't be affected. It would only be the case for new mortgages. And so I think that's a good point. You know, there could be some households who are less likely to refinance because if they're just above the limit, they don't want to lose their mortgage interest deduction. We haven't, thought about that carefully in the paper. We should probably discuss it, but I think that it would in general affect a pretty small slice of the borrower distribution, especially, because most households are not going to be up against that limit. But we'll think about that. Thank you.
Yeah, very interesting paper. Your incentive to atomize depend on your filing status, whether you file it jointly or alone, and how. Just a clarification question. So, what is your itemizing threshold? Is it when you file jointly or individually?
So there are two different thresholds. If you file single, the threshold is about, thank you. So if you file as a single filer, your threshold is about half the threshold for a joint filer. We actually just look at the thresholds for joint filers in this data because we don't observe, like we're just working with mortgage data, so we don't know whether a household files jointly or singly. And so to get around that, we look in the HMDA data and that tells you if there's a co-borrower or not. And so we say, if you have a co-borrower, then we assume you're a joint filer. And then we only restrict to people with co-borrowers. Because we want to avoid the case where you have like a single borrower who's actually a joint filer, and then we're missing their standard deduction.
Yes, Bob Avery, I guess I should say. I'm Philadelphia Fed affiliated now. Looking at this, so the Oakens razor responses, if you had, you go from 30 million to 18 million people who can deduct, that the most immediate effect would be on cash out refis, that when you buy a car, there's no longer an incentive to pay for that through a mortgage versus an auto loan, and you do see an increase in auto loans. So I'm sort of perplexed why you seem to claim that there is no increase in cash out refis, and you don't interpret the auto loan effect from coming from exactly what I said. And that you also expect to see perhaps increases in credit cards and other kinds of borrowings because you're substituting out a mortgage.
Like, I think there's like a couple of points to your question. So we don't see an effect on cash out refinancing following the passage of the bill in the way that you see an effect for refinancing. And we think this is due to the fact that there's kind of offsetting effects. So we know that when you're in the money to refinance, that also encourages cash out refinancing. So because it helps you overcome the fixed cost of doing a cash out refi. So you might think that if more people are refinancing or doing rate term refinancing, then they should be also more likely to do cash out refinancing. However, the TCJA had a number of changes to the tax code, and it also reduced the subsidy for borrowing against home equity. And so that's going to separately reduce the incentive to do a cash out refinance because it's become more expensive to borrow against home equity. So I think, these effects are, we would assume based on our results, we think they're pretty offsetting. So we don't see an effect on cash out refinancing. And it's not clear kind of which effect you would expect to dominate. With your question about auto loans, we think that, we show that following the TCJA, you become, in aggregate, households become more likely to buy a car following a refinance, in the months following a refinance. But we don't see an effect when we interact that with the subsidy loss. So this suggests that, there's something going on post 2019 where households are more likely to use their refi savings, but it's unrelated to the subsidy change. So we're not attributing that to the effect of the bill. Like, there probably is some consumption effect because households are now pocketing more of their interest savings than they were in the past. But it might be, we're not observing it, at least in the probability of opening an auto loan. It could be there are other ways that households are spending that money that we don't observe, such as via increased savings or increased investments that we don't see. So that's kind of our conclusion from the results. And in terms of substitution, like you mentioned, this is we're just looking here at rate term refinances, or we just see an effect, I should say, on rate term refinances, which wouldn't, imply too much substitution with other forms of borrowing, although it would affect, possibly pay down of credit card debt.
I'm going to take the opportunity to ask the last question, if I'm allowed. Aldo Freddy. Okay, sorry.
Pavel Krivenko, Baruch College. Tax Cuts and Jobs Act also changed the federal tax brackets and the tax rates in these brackets. Do you account for this? And if you do, maybe it's still interesting to see separately the effect of federal tax changes and also of standard deduction change.
I'm sorry, you said there's changes in the tax code for, what was the first change?
For federal tax and the tax rate in this bracket. It's not big, but it's there.
And so I'm not familiar with that. You're
So the deduction, the savings from itemizing depend not only on interest rate but also on your marginal tax rate, right?
Yeah.
So when federal taxes changed, the marginal taxes also changed for people differently.
I see. Your marginal tax rate is moving around. So I think that's a really good point, and that's in fact part of the reason why the value to your subsidy is increasing with deduction amount. In part, that's because your subsidy is dependent on your tax rate, which is also changing with your deduction then. So I think that's a great point, and maybe we can kind of elaborate on that more in the paper,
We do account for that, like we do,
in that
we
rate
do
gap
change the
specification.
marginal tax rate when we calculate this.
Okay, so it's a great discussion. The next paper is refinancing frictions, mortgage pricing and redistribution. Dave Berger, Tim first.
Perfect. All right, well, thank you so much, Army. I'm David Burr Duke, strong with some familiar co-authors, Constantine, Caprice, and Joe. So I think there's sort of like two background facts that motivate this talk. The first is there's sort of a large literature. I think point out that there's like an evolving view that for at least the household side, monetary policy is working at least through mortgage markets and perhaps through this refinancing channel. Yet there's a view that like a lot of households sort of refinance suboptimally in the sense of like leaving money on the table. They could lower their mortgage payment by substantial amounts and they're still not doing it. Even when you send them a mailing telling them that they would do it and it would be beneficial. Moreover, there are large cross-sectional differences in this sort of inattention that I'll talk about. You can think about my mother, who does not like calling mortgage brokers all the time. You could think about Joe Vavra, my co-author, who was refinanced 4 or 5 times since buying 10 years ago. The second thing is that despite this sort of heterogeneity, there are institutional limits. Most people get the same rate roughly according, modulo their creditworthiness at origination. There are both legal restrictions. You're not allowed to discriminate based on sort of specific, price based on specific individual characteristics. And then also the fact that these loans are mostly, we'll talk about that later, traded in this TBA market where you only know very average aspects of the mortgage. You don't get to inspect individual mortgages when you sell it in the TBA market. So because of this heterogeneity, we're going to, a literature is developed to show that there's like a large amount of redistribution going on in the mortgage market from slow borrowers like my mother to Joe. So Joe is being cross-subsidized to get to a much lower mortgage rate than my mother would be. Okay. And as a result, people started to propose different things. It seemed, given the role that the mortgage market plays in monetary policy, perhaps we could do financial literacy programs or think about alternative contractual arrangements that could say, limit these subsidies or sort of help the slow borrowers, which we're going to see is, at least in our estimation, are a large fraction of the population. Yet this literature so far has kind of operated in partial equilibrium, taking as given what the lender response would be. And obviously, if you have to think about, in the US, how we funding mortgages to a securitization market, the end are these investors in MBS securities. They don't want to own, obviously, assets that are going to be prepaying in low interest rate environments because then they have to reinvest with low cash flows. So as a result, if we move to a world where everyone was quote unquote more attentive, more likely to refinance, we would expect an equilibrium, rates are going to go up. So we need to write down a framework, a model, which I'm going to talk about today, that allows us to think about how big a deal this would be. This is actually turns out to be a quite complicated problem because functionally lenders face a dynamic kind of adverse selection problem. I can estimate on average how inattentive people are, but at origination, who shows up at my door and wants a loan is going to depend on the past history of rates. And it's going to be dynamically changing. And, at lower rates, it's going to be more likely that the Joes show up than my mother and so forth. It's a hard problem to forecast. So we're going to make a little bit of progress. We have to make some simplifications. And then we're going to allow this, but it's going to allow us, we're going to argue that there are important equilibrium consequences to this heterogeneity. So I'll talk about that. And then moreover, we're going to allow to think about different contractual arrangements. So that people have talked about ratchet mortgages, these auto refinancing mortgages. We're going to see that would eliminate this heterogeneity. Obviously, if everyone automatically just got the rates just moved, if rates fell, then everyone's mortgage rate fell. Of course, that would have to be priced. And as a result, rates in origination would be higher. They're going to be winners and losers. Kind of interestingly, we're going to explore sort of lockup periods or prepayment penalties. And we're going to find that these actually do quite a bit, because they kind of really eliminate the ability of the really attentive types to refinance very quickly. And then finally, let's get a little bit to the discussion in the last paper about sort of aggregate increases in sort of refinancing sensitivity to interest rates. There's been a big increase in non-financial banks and fintech into this market, particularly in refinance. And we're going to show the Quicken Loans of the world actually people who originate, with them tend to prepay much more quickly than say with traditional banks. So just a brief roadmap. I don't have really time to go through it. So I'm just going to walk through the model in stages. My apologies for all the math. So work in continuous time. There's going to be a measure one of individuals. They're going to be discounting a rate at rate row. Think of that. There's no intensive margin. You just have a coupon. It's $1. Or you have a $1 of a notional mortgage. You have a coupon C. That's everything. We want to distinguish between sort of strategic reasons to move and non-strategic reasons to move. So what are the non-strategic reasons? I just occasionally I have to move. I get a job offer in a different city and I move from one to another. I get divorced. I have to dissolve the contract. The loan amortizes. I pay everything off. So we're going to call that new. However, you also have an option to refinance at any time. And we're going to sort of nest the two frictions that this literature is focused on in the literature. The first is going to be monetary costs. We'll call those upfront closing costs. And then the one we're going to focus on in this paper is CHI, this attention rate, right? That people are just inattentive. And for the purposes of this paper, it's just a catch-all. It can catch, I don't like thinking about the banks. I don't want to interact with them. It could also be monetary incentives. I'm unemployed and I'm not able to refinance. So we'll talk about that later. There's going to be a mortgage rate, M, that is going to depend on some primitive state. Think of the individual state here in the model is just like the short rate. Think of the Fed as trading the short rate, and then in equilibrium, there's going to be a term structure, and that's going to deliver the mortgage rate. Okay, and what matters is basically how my coupon changes at DC. So this is a pretty standard problem. What do people do? They choose to refinance optimally in order to minimize their expected future mortgage costs. You can solve the differential equation. So if there are upfront costs, this is very similar to the Driscoll paper. It's just their model plus attention. People follow a one-sided SS rule. So there's going to be some gap. I don't want to refinance all the time. It's going to depend on how big the costs are. That's what that theta is. What's kind of interesting though is that relative to this benchmark that's in the literature with just fixed costs, this attention friction, which I think is very important, and the literature showed is very important, it reduces this gap of what I want to refinance more, essentially. And the reason is, again, if I know I'm inattentive and I get the opportunity, God touches me and says I can refinance, I want to take advantage of that time and that opportunity. Okay, and so we have a recent paper we just put out in MBR that shows, this actually can rationalize a lot of people are making fewer mistakes relative to this model than the previous literature. But and no upfront costs, obviously there's no threshold. Okay, so let's think about, I'm going to just walk through it quickly because it gets complicated. Let's think about the world of just one type of household. There's one prepayment speed CHI. Okay, so there's some, outside investors, they're investing, they're risk neutral, rate R. There's going to be a wedge, F, that's going to basically be given to the servicers. Think of them as G fees. This is the difference between the interest rate, the coupon paid by households, the cash flows of MBS are getting. So there's going to be origination costs. You can think of them in two ways. There's both an upfront cost. Think of these are like the monetary closing costs. And then there's a gain on sale. Perfect competition is going to mean those are the only origination costs. And the mortgage price has to break even. So the price of the mortgage basically has to equal to this. Now the mortgage price is going to depend on the intention rate in a kind of an obvious way. So I'll talk about that in a second. And we're going to think about market perfect equilibrium. So the nice thing about making some simplifying assumptions, you could obviously make them way more complicated, is you can prove some things. So we can prove existence uniqueness when there's no closing costs. Moreover, the mortgage rate is monotonically increasing in intention rates. So that makes sense. So if we didn't live in this pooling equilibrium where there's this heterogeneity, everyone's getting the same mortgage rate, but instead we could price Joe and my mother separately, Joe would get a much higher mortgage rate. Why? Because his mortgage is just a lot less valuable to investors because we know he's going to prepay. Right. So the question is how big that is. So in the risk analysis, we can do it with these. We can add these if we want. It's much more of a nightmare. We can prove some things. We think it's reasonable at a first blush to say ignore the monetary closing costs. Why is that? Well, for multiple reasons. First, in the data, many people, particularly for refinances, roll these origination costs into higher interest rates. Okay, that's number one. Number two, from a pricing perspective, we do these numerical exercises where we have both frictions. Inattention is just way more important for pricing than fixed costs. Why is that? What do the fixed costs help you get? They help you get the fact that people don't like refinance at like 10 dips. Okay, sure. But that's a small amount. That doesn't really matter for the pricing. What does inattention get you? It gets you the fact that there are people who have huge coupon gaps, 200 basis points, 300 basis points. Okay, and they're not refinancing. In a model of pure fixed costs, those are the people that are refinancing. All right, so you have to make simplifying assumptions anywhere. So we're going to focus just on the inattention. See how far we can get. All right, so let me talk about the heterogeneity and assumptions. So in the data, we try to do some tests to say why do we think there's heterogeneity? So we kind of compare the world we see in the mortgage data compared to a world where there's just like one attention rate with some measurement error. And the fact that we think there's heterogeneity is just like some people who essentially never refinance, even though they're in the money. And there are some people who refinance very, very frequently. And it's just really hard to rationalize that with assuming that everyone has the same latent prepayment propensity. So I'll talk about this in a second. We're gonna try to estimate this sort of H distribution. This is the unconditional distribution of attention rates in the data. I'll show it to you in a second. And we're going to think about a model where investors can't screen on that. Why? Because they're basically just legally not allowed to. Okay, or they don't care because they're selling this in this market where you're not allowed to like look at the mortgages anyway. But it's a hard problem because what do investors care about of MBS? They care about they don't care about age. They care about at a moment in time, depending on what current level of mortgage rates are, who's showing up at my door and who wants and like what kind of mortgages am I getting? Okay, so they care about this like endogenous distribution G that's different from this exogenous population distribution of attentive rates. So the true state variable is basically there's this joint distribution of all the interest rates people have and their attentive types. It's really complicated. Moreover, it's path dependent. It depends a lot if like, the problem we're having now, rates fell for a long period of time and then we kept them low, everyone refinanced and now it's up, everyone's locked in. That's very different from a world where, even if we're at the same rate today, rates were high and have just hit to this point. Okay, so it's path dependent too. So we're going to basically solve the model under the assumption that things are state dependent. They depend on the level of rates. That's what lenders are assuming, but they're not taking into the path. So basically, investors break even on average, but not path by path. So the nice thing about these assumptions, which are obviously approximations, is we can prove some things. And they kind of characterize how heterogeneity matters. So first we prove there's a unique pooling equilibrium if the mortgage rate is monotone. But more importantly, you can kind of get this nice formula for how cross-sectional heterogeneity and attention rates affect rates. And so in particular, heterogeneity lowers rates at origination. So why is that? Imagine that they're like we're comparing, so you can see this because what does this equation say? It says the price of a mortgage with heterogeneity in attention rates is equal to the price of a mortgage where they have the same average attention rate minus this kind of covariance term. And this covariance term is about how the price of mortgages varies with the attention rate. And this is negative because people who have high attentive rates have lower price mortgages. Okay, so what's going on? Why is heterogeneity lower rates? Because imagine a world where like I'm at the average attention rate versus more heterogeneity. Like so, imagine there's kind of a very low attentive and a very high attentive, but they average the same average. Well, what happens is basically the effective duration of the pool I'm buying as an investor is longer under heterogeneity. Why? The fast types refinance out quickly, but the slow types essentially never refinance out. Whereas on average, they kind of average out more quickly. So it's actually a more valuable pool to be purchasing as an investor. And so you can see directly how heterogeneity matters, and our calibration is going to be pretty substantial. Heterogeneity is lowering mortgage rates at origination by almost 80 to 90 basis points. Let me, in the last 10 minutes, just briefly talk about, okay, we build a machinery. Hopefully I can do something that's interesting with it. So first, let me measure the attention to the data. We're going to use Prism. So this is basically, a monthly data set where I can follow the loans over time, the households over time when they refinance. And we essentially do an MLE exercise. I mean, think of this as basically a big matrix of zeros and ones, and it's a 0 if I don't prepay, if I'm in the money, and 1 if I do prepay in the money. And we kind of do some very simple k-mean, they're different, MLE to try to estimate the rates. What do we get? This is what we get. So the blue is the unconditional distribution of attention rates in the data. You can see that roughly like, so 40% of people essentially are basically never prepay. I mean, this is netting out the moving part. Okay, this is the strategic reason. They basically never strategically prepay. Whereas, something like 5% of the people unconditionally are very attentive, or the Joe Vabbers. So the Joe Vabbers are just not a big part of the population. This is on the right-hand side, we're seeing how the G distribution depends on the level of interest rates. So we saw this for interest rate, like short rates between 0 and 25%. So at the hot max interest rate in our process, G is equal to H. Basically, who shows up is exactly the origination distribution. But of course, in a moment in time, G is not equal to H. So in low rates, the high types are way more represented relative. And you can kind of see on average what the G distribution is in the orange. So the high types are way more represented than the low types. Okay, so on average, the effective attention rate and distribution is 59% versus on than what it would be in the unconditional. Okay, I'm going to skip the calibration. I think it's a little bit reasonable. Paul might pick it apart. So is this a reasonable model? This is a one-factor model. I don't want to push it too hard, but it looks okay on the pricing. This is also looking at how the coupons evolve. Basically, we fixed the coupon distribution in 2006. We feed through mortgage rates, given our estimated types that we have for each type, and you can see how the coupons evolved. Then we compare data versus model, and what you can kind of see is that, not surprisingly, interest rates for the fastest types fall by far the most fast. After about 6 years, they have rates that are roughly 200 basis points lower. Okay, so it's a dynamic effect of the refinancing that matters quite a bit. Okay, so it's just like dynamic redistribution. All right, so let's look at first how this affects redistribution. So the blue line in the left panel is what our model predicts the mortgage rate would be under the current existing pooling equilibrium. The red dash and the purple dot dash are showing what it would be for if you could price by type. Okay, but for basically the blue is the purple is if it was the least attentive type, and the red is the most attentive type. So you can see, unsurprisingly, the blue is in between, and it's closer to the least attentive type because they're a larger fraction of the pool. Okay. But that's sort of a static way. This is just showing in a slice here is just saying at a moment in time at origination, what is the subsidy? And that is kind of what people have I call that like the partial equilibrium redistribution. At origination, Joe is getting a lower rate than he should be getting, and my mother is getting a higher rate than she should be getting. But that actually kind of underestimates the total amount of redistribution because dynamically, Joe, if the type is persistent, prepays many, many times. So on the right-hand panel, we plot this, ergodic average coupon. So to focus on the partial equilibrium redistribution, you can just kind of look at the difference between what the average coupon paid by someone in the pooling equilibrium is and what it is by type. So you can see the fast types getting a very large subsidy over time. On average, it's paying roughly 60 basis points lower, whereas my mother is paying roughly, 30 basis points higher. The difference between the blue and the red. However, the black dash line highlights the equilibrium consequences of the heterogeneity. So here is what if lenders could price on type. So let's look at the separating equilibria, and you can see that if you could do that, then Joe would be getting a much higher rate. So just to kind of summarize this, we have this simple table where we have the types from least attentive to most attentive. And then we kind of highlight this partial equilibrium redistribution versus the general equilibrium if we could change the pricing. So the partial equilibrium is within the existing pooling equilibria. The general equilibrium is the if we could also change the pricing. And not surprisingly, it correlates with obvious covariates, FICO score, income, education, things like that. So suggests that these subsidies are regressive. Okay, so what can we do about them? Talk about in the last 5 minutes. The literature said, okay, this seems regressive. We don't love this. Why don't maybe we could get welfare gains from, increasing attentiveness. So one thing people thought about is automatic refinancing mortgages. So what is this? It's like a smart contract. Essentially rates reset if rates fall. Okay, so this functionally is equivalent to a world where people are infinitely inattentive. So, what's kind of interesting is, I mean, this contract is, you know, we're not having to pay origination costs, so it's a little bit unfair, the comparison we're doing. What's kind of interesting though is if this, you know, in the model, if this contract were introduced, it would actually unravel the entire mortgage market. Why? Because if, you know, I mean, I think it's a bit unrealistic because people have to be aware of it and so forth, but and, you know, people have to trust it. People really love the 30-year fixed rate. People in this room know. But in the context of the model, it would unravel it because the least attentive types, the slowest types would love this mortgage. They would leave. That makes the pooling equilibrium less attractive for Joe. And so it just completely unravels. So, but from the perspective of the equilibrium consequences, you know, the auto refi mortgage would have to be priced. And on average, it would have to be about 98 basis points higher. Basically, why? Because it's allowing people to prepay, you know, MBS investors would not love the auto refinancing mortgage, maybe not the mortgage industry as well. And so this would have some consequences as well. You know, we do a very kind of naive experiment where we say, you know, many people are exactly at their, you know, debt to income constraint. This would force, you know, around 15% of households to sort of choose a different allocation of housing. Because rates would be higher, they would be able to get a less expensive house. Okay, but the cross subsidies would disappear. I think kind of interestingly, because you know, typically now we're kind of in a second best world. Here we think about how would now we consider a contract where there's a lockup period. Now, this is a little anathema to the United States. We do not like putting constraints on ourselves, but other countries have prepayment penalties or lockup periods. And here what we're explaining on the left-hand panel is what would happen to the average regatta coupon if we had a lockup period for, you know, roughly, you know, 1 year, 2 years, 3 years, 4 years, 5 years. And you can see that, you know, rates would fall pretty significantly. Why? Because the lockup periods really hits the fast attentive types, you know, and they're doing a lot of inefficient refinancing. David Chang has a very nice paper highlighting this. And you kind of see this because let's think about with the lockup period on the right-hand panel, we think about a lockup period of 2 years. I think it's kind of reasonable. And you can see that basically look at how the equilibrium response changes. This the solid red line is what happens in sub-equilibrium without the lockup period, where the dash is with the 2-year lockup period. And you can see basically the Joe Bobbers of the world would be, you know, get a much lower interest rate under the lockup period. Okay, so you can remove, you don't have to go to the full auto refinancing mortgage to get rid of the cross subsidies. And the kind of a reasonable-ish lockup period to me does a pretty good job. And actually kind of, you know, doesn't make everyone better off. The high attentive types are still worse off, but you can do you can remove a lot of the negative cross subsidization. Okay. The last thing I want to say is, you know, there's been, as was highlighted yesterday, this large increase in sort of non-bank lending in this mortgage, particularly in the refi market. And if you estimate sort of prepayment propensities for them, you can see this is sort of looking at non-banks versus banks. So the non-banks have roughly around 100 basis point higher prepayment propensity. Okay, so you know, they email you all the time, reminding you and so forth. And the question is, what effect in equilibrium has this had on interest rates? This is a bit related to your comment. And we estimate, actually, this is very similar to an RCT that was recently done in Ireland, where they were trying to increase attentive rates, you know, for equilibrium. We find it raised rates around 35 basis points. Okay, so one thing I will say is, you know, we have this catch-all inattention. What is the inattention? Is it something financial? Is it something behavioral? I think it's probably a bit both. It matters a bit for policy. So I just want to state that, like, I think it does matter quite a bit. Like, for example, Denmark allows refinancing without income verification. Maybe that's something we should think about in the US. I don't know. So last thing I was going to say is, so what have we done in this paper? We have this sort of tractable mortgage model of the cross-sectional difference in attention. Heterogeneity is actually a virtue. It has lowered mortgage rates in the US, but it also leads to a lot of kind of redistribution that's regressive. However, getting rid of that may also have some adverse consequences. We just need to think a little bit more deeply about it before we sort of start changing things. Thank you so much. I look forward to it.
Discussant is Paul Willen, Federal Reserve Bank of Boston.
Oh, sorry. Slide it didn't show.
Never mind.
Okay.
I'd like to thank the organizers for inviting me to discuss this excellent paper. And I won't say my usual disclaimer. I only have 10 minutes, and so I'm just going to dive right in. I'm not going to review the paper. I'm going to say that I interpret this paper as a paper, or the way I see it, maybe through the lens of my own work, is through a paper about the cross-section of spreads that borrowers pay. So the status quo, roughly speaking, is that all borrowers pay the same spread when they get a mortgage. And the counterfactual in the paper is to think about a world. I think the most interesting part of the paper for me is to think about a world in which we have attentive and inattentive borrowers, and they prepay at different speeds, and they receive they pay a different spread. And so what I'm going to argue here, I think what I learned that I hadn't really thought about before when I read this paper, was that there are really two different cross subsidies from inattentive to attentive borrowers. The first one is the one that we always focus on and that I thought about, which was about the prepayment option, which is that basically the prepayment option is much more valuable to attentive borrowers. But the second one, that's more subtle here, is that the inattentive borrowers are basically paying the closing costs for the attentive borrowers. And so I am going to, you'll have to bear with me, but I wanted to use some slides from my own, as a discussant, you're entitled to reuse slides from your own presentation. So I'm taking, this is from a paper, actually with several people in the room, Fuster et al. And this is, I'm just going to talk about a decomposition. So I'm going to talk about spreads over time, but I'm going to argue that they give us insight into spreads in the cross section. So this is the FRM spread here, is the spread between the fixed rate mortgage rate and a 10-year treasury rate. And you can decompose that. We decompose that in our paper at Fuster et al. Into the primary secondary spread, which is the difference between what the borrower pays and what MBS investors receive. And then you can further break that down into a yield curve adjustment and the three things, which are option adjusted spread, the yield curve adjustment. The one I want to focus on here is this option cost, because that's the price of the option. And what you can see here, and actually Mike mentioned this yesterday, is that we've seen the spreads. So since 2021, we've seen mortgage spreads go way up. And a lot of that is because of the increase in the price of the option. So the prepayment option has become much more valuable. Why has it become much more valuable? So this is based on swap data. What I'm plotting here is the distribution of 5-year forward expected long-term interest rates. And basically what you can see here is that in 2021, people expected interest rates to go up. The probability that interest rates were going to come down was low. And now we see the probability that interest rates are going to go down. So this portion here, right? That's interest rates. Investors expect in the mean to go down. So they expect 5 years from now, interest rates will be, whatever it is, 20 basis points lower. But there's a 1 in 6 chance that they're going to be more than 100 basis points lower. And so this is the option. So basically this green part is the option is going to be in the money in 5 years. So a lot of people are going to refinance. And the red is the option is out of the money. And so basically what you can see here is that the option has become much more valuable. And the reason it's become much more valuable is because interest rates are high now and people expect them to go down. In addition, the dispersion has gone up, but the mean has also come way down. So in other words, the option is expected to be in the money in the future and is much more valuable. And so the option is costly to the lender. And so the lender is charging more but it's also beneficial to the borrower. So in some sense, the borrowers aren't worse off now because they now have this very valuable option. Okay, so the point here is if we fix the option cost at the 2021 level, then borrowers would be getting a big subsidy now. And that is the option cost, and that's what's going on in the time series, is what's going on in the cross section in this paper, basically about the option becoming much more valuable. Okay, so that's the first part of this. The second part, though, is about closing costs. So why are closing, and I'm talking closing costs here, it's always complicated in this, in the mortgage space, what exactly we mean by closing costs. But what I mean is what we call the cost of intermediation. It's the cost for a lender of basically matching, of what an intermediary does, of matching a borrower with an investor or a lender. And this is gain on sale is basically measuring that cost. And that cost is paid by the intermediary as a stock. It's paid, it's a one-time cost paid when the loan is made. And our estimates here is it's around, typically between $2 and $3 per $100 of principal. And if you want to know why it was so high, there you can read our paper. The point is, it's a one-time fee, but it's paid by the borrower in the form of this primary secondary spread, which is the difference between what the borrower pays and what the investor receives. And so the borrower is paying it as a flow, but the cost is incurred as a stock. Okay, so why is this important? Well, what it means is that the one-time cost is spread out over the life of the loan. So if you have the loan for a long time, you pay a lot of costs. And if you have the loan for a short time, you pay very little. But since the lender doesn't know, they charge everybody the same spread. And so what's happening here is that in the model is that the inattentive borrowers, because they have the loan for a long time, are basically paying the closing costs for the attentive borrowers. And why is that important? So to go to this picture here. So this picture is something that's puzzling. The pooling equilibrium, we all understand why the attentive borrowers over the life of the loan are paying less. And you'd think if we get rid of the pooling, everybody would pay the same amount over the life of the loan. All loans would have the same expected return, but they don't. The attentive borrowers are actually paying more. And so it's bad to be attentive. So so David's mom is doing better than Joe. So Joe, and there's nothing Joe can do about it. So if we had a separating equilibrium, Joe would be worse off than the inattentive person. And why is that? It's because he keeps repaying this closing cost over and over again. And so a lot of the subsidy here is not because of the option. It's because in the pooling equilibrium, the frequent refinancers are basically, their closing costs are being paid by the infrequent refinancers. And so that was the thing I learned. And the reason why the auto refinancing mortgage is so good is basically because it gets rid of the closing costs. And so the problem with the churning of mortgages that we have is part of it is this, pooling is the people paying for the option who don't need it. But the big problem with it is it generates, and if you want to find out more, you can read our paper about how much money mortgage lenders made in 2020 and 2021, basically on that gain and sale. Okay, and I think I'm out of time. So.
Yeah, okay. Sorry? Yeah.
Go ahead. Okay. Did you want to respond or I don't know?
I see.
You have a choice.
Oh, no, I mean, that was great. I learned about, it's nothing better than getting a discussion where you learn about your paper, so.
So a quick question here. I mean, we talk about this as almost an unobservable, but of that 80 basis points, or which is a pretty good estimate, between Joe and David's mother, you can observe most of it. It's LTV FICO would explain probably about half. You also have history of who's refied in the last few years. The secondary market chooses not to price that. You could do very easily cash window, you could do whole loans. You can do buy up and buy down grids by LTV FICO. You can, when you do the loan level adjustments, you could, add credit and prepayment together. These are policy choices. So it's interesting that we don't do it on that. So sort of political economy, but I was wondering your thoughts of how much, why we don't and what the equilibrium would look like if we just went ahead and price the prepayment and the buy up and buy down grid, which is sort of the closing cost component by observable characteristics.
It's a great question. I think the equilibrium would look, obviously it'd be more moderated, right? I mean, for sure. I guess I don't have anything, I'm more curious to hear what people who are more seasoned than I have to think about why we don't do this. I'm always I'm young, or youngish, sorry, but surprised that there's less change in mortgage markets than there are. So I'd be curious to know why we don't do this. It's a good question. Nancy. Yeah.
No, sorry. Wallace, UC Berkeley. So I'm going to follow up on that. And it was part of what was discussed in some way yesterday, in that you're assuming the TBA market is a pooling equilibrium. It is, it's a market for lemons, but there's control for those that are selling into the market. And that's back to your point about who's using the cash window and who's using the swaps window. And the big guys, the big aggregators, the big 19, they're all using swap. And so they know exactly what they're holding of the quote unquote pools that are originated. And that isn't in your model. And so it's sort of building on what you were just asked. You have that one piece of it that's pooling, but in fact, it really isn't. There's huge heterogeneity there in terms of what the investor returns are given their information control on that contracting space that they observe.
So, I agree. There's the spec pool market has gotten bigger over time. I view that as the next paper. I agree. There's like a lot more to do, but yes, we're showing one part of it, but not the entire piece. For sure. Yeah.
This is a super nice paper here, and I have kind of a question on the prediction. So we keep hearing about how if the Federal Reserve would lower interest rates, everybody's going to rush and refinance and suddenly be able to buy their homes when they go from 7% to back down to 3%. But your model, would that predict that, or would it still predict that this kind of attentiveness is going to matter for the refi rates?
I think for sure attentiveness would matter. Also the fact that so many people are locked in. I'm certainly not going to prepay. I've already prepaid. So, but I think there obviously there's a new flow. The flow is not as large as it was before. So I do think you would see a refi boom, but I would be surprised if it was anywhere near what we saw the last year, personally.
James. Yeah, I was going to offer like Paul, I'm a fan of the ratchet mortgage. And I would say like the ex ante effect of that contract design and rates is completely dependent on the structure, right? You could easily build in something like a lockout period. You could sort of say, look, we're going to observe this at intervals which are relatively infrequent, once a year or once, or you could say, we don't do it in the first 2 years. And the benefit of that relative to just a regular lockout period is exactly what Paul said, which there's this huge like cost of intermediation in the mortgage market, which you avoid because this would just move automatically like an arm.
So you're thinking,
I guess it's,
you're thinking like it automatically falls, but it has to be at least 50 bips or 100 bips.
Yeah, or so it'd be interesting for you to kind of like reverse engineer in some sense. You could sort of say, you got, ask the opposite question. What would be the structure of the ratchet mortgage that would keep rates ex ante the same as what they are now? Would be an interesting question.
Good question.
I had a question, kind of something you mentioned at the end, with regard to the fintech companies. So there are some fintech companies that are specifically originating mortgages for the purpose of selling them to banks. And so do you observe the same behavior with the attentiveness of those borrowers that got loans from fintech organizations when they sell them to banks? Or does that disappear because it's solely because the fintechs are continuing to ask them or inform them of the current rate structure?
So right now, when we just did like a super simple exercise, we have not looked at that, but that would be interesting to decompose. Good question.
Yes, back there.
This is Yusuf Kim, Federal Reserve Board. I'm just going to echo some of the comments I made earlier about the cash window and the MBS swap. These lenders choose to go to TBA market because I don't think that deviating from TBA market is not really beneficial for them. And then you find like a lot of heterogeneity in terms of the cross subsidy between more attentive borrowers, low attentive borrowers, and cross subsidy like 80 basis point. And the literature found the benefit of TBA liquidity is like 50 or 40 to 50 basis point of MBS price. So the amount of cross subsidy you find seems to be really large compared to benefit of TBA market. So maybe the lenders not deviating from TBA market because the attentiveness is not like well known to them ex ante. Is that the reason?
I mean, yeah, so I would say like, R80, that's a very extreme example where you could exactly observe the attentiveness, and obviously, there's a lot of, one feature of the empirical exercise we did is like, yes, observables do explain quite a bit, but there's a lot of heterogeneity. For example, like I know lots of economists who are stuck in high mortgage rates or, just having a PhD is not sufficient for, an optimal refinancing. But yeah, good question.
Hi, Sam Hughes from the Office of Financial Research. My understanding is that the large banks, the GSIBs, have specialized over time a lot more in jumbo loans. And I was wondering the correlation between jumbo loan borrowing and attentiveness, and if there are incentives you could speak to towards, I guess, why big banks maybe would be more likely, I would guess, based on maybe speculating on that correlation, would specialize in the more attentive borrowers for balance sheet lending. I could be wrong about some of those things, but I'd be interested.
Yeah, so I haven't actually specifically looked at jumbo loans, but your intuition is what I would expect, which is that they are more attentive just because they're richer, larger borrowers who, to get a jumbo loan, you have to be typically richer and probably higher FICO and things like that. I guess I don't know. I would have thought the opposite, which is like, I kind of understand why the non-banks would specialize in the non-jumbo because it's usually securitized, you know what I mean? And then, so it's sort of like they were left with it as opposed to it was a choice, but I don't know.
Yes.
Hi, Larry Katoma, Cornell Johnson. So I just wanted to follow up on the open question slide you had. So how do we really say that this is inattention and not costs in the form of some behavioral story maybe? So I'm overwhelmed. It's scary to be on the phone with someone who knows way more about finance than I do. Maybe all the branches closed in your town, or there's like a discrimination angle. So kind of moving I'm fairly not super familiar with the inattention literature, but really saying that this is actually inattention and not some other driver. Kind of what are the next steps there? Thanks.
Great question. Again, I think of inattention as a catch-all. We do exercises where, and this is also in previous work that I've done, where you condition on high FICO, people with a lot of equity, so that it can't just be the financial constraints per se. We don't observe unemployment rates for the borrowers, so that's a bit hard to see, but we try to do whether it's just. I think the question is going to be a bit more difficult to answer using US data. So there is interesting work in Denmark where that has a very similar fixed rate structure where much more about the borrowers, where people have really tried to tease out whether it's attention and what specific type of inattention, but I think that'll be where we'll be able to do it. Good question.
Okay, I think there's a good time to bring our session to close. I want to thank the
presenters, the discussants, and the audience as well.